And so we're heading into September now. This year's had a really interesting rhyme with 2008. A big bank goes bust in March, just like in 2008. We see a volatility swing during the summer, just like in 2008. Now coming out of the summer, vol starting to rise. And the cause of these issues, they're beginning to perk back up. Higher yields really could be the death knell for some institutions coming out over the next few weeks, if only because people are looking around saying, what's the point of holding on to this equity? What is it worth to me? Why would I want to take the risk of having my deposits in an institution that wouldn't have survived otherwise? September could be shaping up to be something far more interesting than we ever hoped for, and that's not a good thing if yields continue to move up.
Last to last, we are back, my friend. You know what that means? Let me explain with Chris. What's going on, Chris? How are you, Mr. Vecchio?
Gentlemen, I'm doing much better after hearing the office banter in the background while we were getting ready.
We've often talked about doing a show of just our off-camera conversations. What would it be? Musings from afar, something like that. But we've never done it. It'd be good.
I heard the voice of God just chime in there and give us an affirmative no.
We started.
That'll be happening.
Well, that voice of God, who sounds like a woman, we started trying to get there with the Ocho channel. We had like an Ocho channel thing going, and we would do like, the research team would come in and we would talk with them, and they would go over their research pieces, and we would critique them a little bit and talk to them in a uplifting way. Beth put an end to it, so we can't do it anymore.
She was everything. She is the fun back here.
She was practicing on being a mommy back then. Now she's a mommy. She might let us do it because she knows you can't limit everything from everybody. You got to let them have some things.
Not going to happen. Sorry.
All right, what do we got today, Mr. Vecchio?
Nvidia's up $3.40. You happy now?
Yeah, you took me down.
Nvidia is probably one of the three important stories that's unfolding this week, right? If you're going to see the AI narrative actually not deflate, you probably need to see some substantive evidence that companies are buying up the computational power that they need in order to fund their AI revolutions. And so Nvidia, being a chip maker, of course, is at the tip of the spear. They had a huge day yesterday, 8.47% gain. Today, they're a little bit softer, bobbing back and forth, not before moving up to what looked like fresh all-time highs. The other two, of course, being China and the Federal Reserve. Now, we spoke about China last week. Things really aren't getting better on that end. To me, it's a mess, and this could be the big one. We're finally seeing the Chinese property bubble burst. But this week is the Jackson Hole Economic Policy Symposium, which I know you guys are very jazzed up about, so I figured we'd spend a good chunk of our time this morning discussing. It's the Fed's annual meeting in which they basically give a lay of the land for their big picture monetary policy ideas. In recent years, they've done things like discuss the R-star, the neutral rate of growth, that Goldilocks interest rate between growing an economy and shrinking it, keeping inflation steady or letting it go up or down, keeping the labor market on even keel or seeing it improve or get worse. We've also heard about average inflation targeting, with the Fed shifting away from its firm 2% commitment to basically somewhere in that neighborhood. The conversation this year, I think, is actually going to be pretty dull. For traders who are looking for a binary event risk at the end of this week, expecting Fed Chair Jerome Powell's speech to bring about a new wave of volatility as we go into the weekend, I'd say curb your enthusiasm. Federal Reserve has been remarkably consistent with their messaging over recent weeks and months, where they continue to tell us inflation's a problem, and they'll let us know when things change. Now, we're going to have some appetizers, hors d'oeuvres coming up here the next few days. In particular, today, 3 Fed speakers are on the docket, in which we will see the puzzle pieces slowly come together for Powell's speech. And why do I say that? The Powell-led Fed has not really seen any dissents at recent meetings. What the individual members say is ultimately what Powell says in summary. And so this Friday, with this big get-together of all these central bank head honchos, bigwigs out in Wyoming, there is a natural inclination for people to look for more volatility. I would say the Fed does not matter right now. And I say the Fed doesn't matter right now because inflation isn't defeated, the economy is growing, the labor market's still strong. So why, oh why would they ever think about backing away? The market's starting to get the hints as well, gentlemen. Fed funds futures are beginning to price in a slightly higher chance of a rate hike in September, up from 10% last week to 16% where we stand today. That's still below my 55% threshold. If you actually go back 30 years, anytime Fed funds futures have priced in a 55% chance of greater than for a rate cut or a rate hike. The Fed has delivered on that 100% of the time. There's been a few instances where it's been like a 52 or 53% chance for the Fed to do something, and they actually have not. But at 16%, that means the Fed is unlikely to raise rates in September. Odds are that they could potentially do something in November. But this market is really seeing that push out at the longer end part of the curve. So, guys, I'll ask you, what are you looking forward to this week most? Is it Nvidia earnings? Is it for something coming out of China? Or is it Jackson Hole?
Guns N' Roses for Tom.
Yeah.
Thursday concert. He's looking forward to that.
So I'm looking forward to the Guns N' Roses concert at Wrigley on Thursday night.
Oh, that sounds fun.
But I did pick up something you said. You think I'm not listening. That 55% thing is a good number. I will keep that in my head for future reference. So I didn't know it was 100%. I could run with that.
I think for us, there is no question. It's not even, there isn't even a competition. The Nvidia earnings are 10x.
They are the Fed?
They're 10x bigger than the Fed for us. I mean, the Fed is basically, even though we're sitting here long bonds and
sucking wind.
I think the Fed is pretty much, been neutralized for the time being, and I don't think there's anything that the only thing that could happen from any of the Fed talk this week is that bonds go higher, the way I see it. But the big trade, but there's no trade there. Either you're long bonds or you're not. You're not going to get short them at 117.5, that kind of thing. So the only trade is in Nvidia, and I mean, we're going to be short premium in there because we already are. Question is, how wide do we want to go, and and how far out of the money, and there's going to be all these questions about expected move and all the craziness about Nvidia. So I think this is a pure and simple. This is all about Nvidia. The other earnings plays last night were all good, and I think those set the tone. But this week is all about Nvidia. I don't think the Fed, like I said, we are long bonds. We'll stay long bonds, and our bond premium positions are relatively, nothing.
Being long bonds is effectively a trade of being long the Russell and, quite frankly, being long the regional banks right now. I was looking at the 5-day and the 21-day.
Yeah, the Russell hasn't really, the Russell's been, the Russell has been weak, but it hasn't been as weak as the bonds.
No, it hasn't, but the correlations on a 1 week and 1 month rolling basis are pretty tight right now. For the 1 week for the Russell, it's 0.86. For the 1 month between the Russell and ZB, it's 0.88 right now. And that goes to show that the market is still exhibiting concerns over the regional banks. Same thing with KRE or IAT. If you look at the regional bank ETFs, the correlations for the 5 and the 1 month rolling VCs are going up into about the 0.76 to 0.82 positive territory. And even though there's no, shoe that's expected to drop, right? We're not hearing about another bank like a PacWest, for example, that may be teetering and looking for a buyer. You have the situation where even though the Fed, through their lending facility, has pumped hundreds of billions of dollars now, 107 actually billion dollars into the banking system, allowing banks to basically borrow against their underwater positions. If your bond is trading at 60 cents on the dollar, the Fed will treat it like it's trading at par. You see that these unrealized losses are still stacking up on the balance sheets. They haven't declared them a mark to market because they're holding them to maturity for tax and accounting reasons. And so if you're an investor in one of these banks, if you're a depositor in one of these banks, what do? You see a bloated entity that is unlikely to remain profitable or survive without federal intervention. And it's effectively a zombie. Zombie banks, we heard all about these coming out of the global financial crisis, institutions that would otherwise have died without the intervention efforts by central banks, by the Treasury, the FDIC, different authorities over in Europe. And so we're heading into September now. This year's had a really interesting rhyme with 2008. A big bank goes bust in March, just like in 2008. We see a volatility swoon during the summer, just like in 2008. Now coming out of the summer, vol starting to rise. And the cause of these issues, they're beginning to perk back up. Higher yields really could be the death knell for some institutions coming out over the next few weeks, if only because people are looking around saying, what's the point of holding on to this equity? What is it worth to me? Why would I want to take the risk of having my deposits in an institution that wouldn't have survived otherwise? September could be shaping up to be something far more interesting than we ever hoped for, and that's not a good thing if yields continue to move up.
No, and that's a good point. The question is, when you look at various markets now, and I'm not saying that this is any reason to buy anything or whatever else. When you look at every market right now, if you're looking for the market that is the most oversold, and if you're also looking for the market that looks like it's most out of whack, it'd probably be the bond market. It's not going to be the stock market. So when I look around and I think, like what happens, let's play out the scenario you just talked about. Let's say, okay, September's a rough month for the stock market, so the stock market goes lower for whatever reason, and doesn't really matter the reason. The stock market goes lower. Well, bonds probably won't go lower with it. They've been trading pretty inverse. As of late, stock market's gone up, bonds have gone down. It's been an inverse relationship. So that's just another reason, to like the bonds here. I think, just from, I'm talking myself into the trade, but that's kind of the reason, I mean, there's a lot of reasons why I don't think you can be short. You can basically bet on rates going higher here, especially short-term rates. I don't see how those things go too much higher. Yeah, I mean, I think those.
The Fed doesn't need to raise rates again. For the short end is probably stuck where it is right now for the foreseeable future, because higher for longer doesn't necessarily mean another rate hike. It just means when the Fed first cuts gets pushed back further and further. And we've seen that here happen over the past 2 or 3 weeks. The market was pricing in a March rate cut at the start of August. It's about a 65% chance when you take a look at Fed funds futures. Now the implied rate cut odds for next March are down in the mid 30s. And so higher for longer doesn't mean the Fed needs to raise rates again in September or November. It just means that first cut gets delayed, say to June, maybe even to next September. An economy growing at 5.8% according to the Atlanta Fed GDP Now growth tracker with an unemployment rate of 3.5%. The Fed and these academics, these people who staff the board of directors, the FOMC, they are Phillips curve economic theorists. They think that there's an inverse relationship between inflation and the jobs market. The jobs market is too strong to bring down inflation, plain and simple, so they will persist. But Tom, I agree with you. If we do see something go thump in the night here in September, if another bank begins to break down and there's concerns begin to rise once more, what happened in March? Bonds went bid. Everyone wanted to buy bonds. The same thing happens during debt crises. What happens? Everyone wants to buy bonds. Where else are you going to go? And so we could be reaching that inflection point once more where things get so bad, bond yields moved up so much that cracks in the system start to appear. And ironically, then the yields come off, bond prices rally sharply. It's that curve steepener, though, to me, that still interests me. If we do see one of those situations, what happened in March? Well, the curve did steepen. And if we are staying higher for longer and there's this correction at the long end of the curve, yields are going up, that does mean steepening. It's a bear steepening, not the kind that I'd be looking for a longer term play, a bull steepener, but it would be a steepener nonetheless. And so for me at these levels, I think that you're looking at some, fairly high convexity trades right now. Try to pick a bottom in bonds, maybe a fool's errand, but the pot odds are in your favor of saying yields can't really go up more without something breaking. And when something does break, bonds come back in favor.
Yeah, and
nothing's broken yet. Bonds down 6.
Yeah, nothing's broken. But as far as the steepener goes,
of course,
you can, it's still a great. I love that trade. It's probably my biggest position. I mean, it hasn't helped us or hurt us yet. Recently
we put it on a little bit early, went against us early, and then now it's come our way nicely though.
It's coming well, not today, but it's coming our way.
Yes.
Yeah. I mean, it's the kind of trade where, you're in for a penny, in for a pound type thing. You're in.
You're in on the side of logic, right?
Yeah, you're in on the side of you're in on the side of the argument that you just made without really having to make that argument.
Right.
Like I'm making, it's the classic. It doesn't matter how you got there, but you just got there. So, yeah, I just don't know. My biggest thing with this market right now is just I feel like there's so many underlyings that are, that could just roll over, and like Nvidia
have already by 10%.
Yeah, but Nvidia being a perfect example of here's a stock now it's down 5, was up 12 this morning. I know yesterday had some stupid ass move that was insane, but we're at that point.
I would argue if Nvidia goes, then the rest of the market goes.
I don't see how it's not possible. Right.
But yeah, it's been the backbone of the whole AI narrative. Again, you need the computational power if you're going to build these LLMs. And so if Nvidia is seeing falling demand for its chips, well, that means the AI bubble is probably deflating. Already bots, the robotics and AI ETF, has seen a fairly significant move lower here in recent weeks. It actually just hit the measured move off of its double top highs. And so perhaps there's a little bit of support coming into play. You could see this on a technical basis in the Russell and the S&P and the NASDAQ. There are very short-term bottoming efforts trying to come together over the past 3 days. Whether or not they hold is another story. The nature of the technical downtrends haven't changed that much. The characteristics of a bear move remain in place. But if Nvidia goes, then forget the bottoms. If the banks go and the Russell gets dragged lower, forget the bottoms. Quite frankly, those are the two most important things I'm looking out for. The China story, it's indirectly impactful to the United States. We've seen previous episodes, like in September 2021, when the Chinese property sector reared its head with Evergrande. Oh, that impacted U.S. stocks for a little while, but it's hopefully not going to be something the Federal Reserve can do anything about. They're not going to lower rates because of what's happening in China. What would a rate cut do for the Chinese property sector? Nothing. Just like addressing supply chain issues because of Russia's war in Ukraine. What can the Fed do with that? Nothing. You could actually make an argument that rate cuts might help because you would want to see more capital formation go towards building out certain capital infrastructure, like, say, new ports or new LNG facilities, and having lower rates would make the credit flowing to those kind of projects easier. But that doesn't help the inflation story. So what can the Fed do? The Fed can't do anything to address it. Fed's not going to care about China unless it absolutely wrecks the global economy and weighs on the U.S. And right now, it's really not. And so we are still here, higher for longer, higher for longer. Bonds, though, if they do break a little bit more from here, lots of other parts of the economy could come under pressure. So it's banks, it's Nvidia. Sorry, Fed. You take a backseat from me this week, even though it's your annual conference. I don't think it's going to be much of anything at all.
I couldn't agree more with that wrap up. That's exactly what I think. Fed takes a back seat. I don't know how much the banks played in, but Nvidia, I think it's the whole move. And
Nvidia expected move just about $50.
I know it's up. It's up. It was like, wasn't it like 44 the other day?
Yep.
It's up to 50 right now.
Val's up.
Yeah. The hardest thing about Nvidia is going to be after the last move, which was 3x the expected move. You know, how far out are you going to go? And is it going to be another upside move?
Well, there are plenty of strikes, so you can pick your poison.
It's a tough one. Mr. Vecchio, thank you so much. That was good stuff today. You came fired up.
Thank you, my friend. We're going to take a quick 90-second break. You talked about the Russell just a moment ago. It just went red, down 4. Even the S&Ps are up 2.5. We'll be back in 90 seconds. We got more Tasty Live coming up next with a market measure. Thanks, Chris.